Good morning, everyone, and thank you for being here today. I'm excited to present to you a detailed analysis of the Shringar House of Mangalsutra IPO. On this first slide, you'll see the title and subtitle, Apply or Avoid, a Balanced View. Over the course of this presentation, we'll explore the key aspects of this IPO, weigh its potential benefits and risks, and help you make an informed decision. Let's get started. Let's take a closer look at the key facts of this IPO. The issue is scheduled to open from September 10th to September 12th, 2025, with an anchor day on September 9th. The price band has been set between Rupee 155 and Rupee 165 per share, giving investors some flexibility within that range. The lot size is fixed at 90 shares, which means the minimum investment at the upper price band would be Rupee 14,850. The total issue size is approximately 400.95 crore, and it's a 100% fresh issue, so all the funds will go directly to the company. For trading, the shares will be listed on both NSE and BSE, ensuring good market access and liquidity. Lastly, the book-running lead manager for this IPO is Choice Capital Advisors, who will oversee the entire process, helping to ensure everything runs smoothly. This slide gives us a clear overview of the IPO's key details, which are important as we evaluate the opportunity and understand how the process is structured. Let's start by taking a closer look at our company overview. We are a Mumbai-based organization that specializes in manufacturing Mangalsutras and jewelry. Our focus is on producing high-quality pieces that cater to both retail jewelers and institutional clients, ensuring a diverse customer base. The company is led by the Thadeshwar family, who are the promoters behind our growth and vision. In terms of positioning, we see ourselves as a large-scale, organized player operating within a highly fragmented market. This means we have the scale and structure to compete effectively while serving a variety of customers. Overall, our company combines traditional craftsmanship with modern scale, aligning well with our broader goal of strengthening our presence in the jewelry industry. Let's take a quick look at our financial snapshot. For FY23, we achieved a revenue of 950.2 crore rupees, although the PAT or profit after tax data for that year isn't available right now. Moving into FY24, revenue increased to 1,101.5 crore rupees, and we also saw a PAT of 31.1 crore rupees. Looking ahead to FY25, we're projecting revenue to reach approximately 1,429.8 crore, with PAT doubling to 61.1 crore rupees. This shows a strong growth trend, with a compound annual growth rate of about 30% in revenue over these years. And importantly, our PAT is doubling by FY25, which underscores improving profitability alongside revenue growth. These numbers are significant because they highlight how our business is expanding rapidly, and the doubling of PAT indicates that we're becoming more efficient and profitable as we grow. This financial momentum is a key part of our overall story, demonstrating solid performance and promising future prospects. Now, let's take a closer look at the valuation at the price band. Post-issue, the company will have approximately 9.64 crore shares outstanding. This helps us understand the scale of the company in terms of its share count. The estimated market capitalization ranges between 1,495 crore and 1,591 crore, depending on the final pricing within the band. This valuation gives us an idea of how the market perceives the company's overall worth based on the current offering. Moving to the multiples for FY25, the P/E ratio is projected to be between 24.5 and 26 times. This means investors are willing to pay about 25 times the company's earnings, which is a useful benchmark for comparing with industry peers. Similarly, the price-to-sales ratio is expected to be in the range of 1.05 to 1.11 times, indicating how the market values the company's revenue. And to give you a snapshot of profitability and scale, the projected profit after tax is around Rupee 61 crore, with revenue estimated at approximately 1,429.8 crore. All these metrics together help us gauge how the market is valuing this company now and what we might expect in the coming years. They're essential for understanding the investment potential within this overall theme of growth and opportunity. Let's now take a closer look at the use of proceeds, which amounts to 400.95 crore. The major part of this, approximately 280 crore, is allocated towards working capital. This is crucial because it helps us maintain smooth operations, manage day-to-day expenses, and support growth initiatives. The remaining funds are designated for general corporate purposes, which could include strategic investments, technology upgrades, or other corporate needs. Overall, this allocation aligns with our goal of strengthening the company's foundation while fueling sustainable growth. Let's take a closer look at some of our key strengths. First, we are the category leader in Mangalsutras, which really highlights our strong position in this segment and the trust we've built with our customers. Moving on, we've seen robust revenue and profit growth, or PAT growth, which reflects our ability to expand and generate value effectively. Our margins are also improving, indicating better efficiency and cost management. Lastly, our business model is quite straightforward. It combines manufacturing with distribution, allowing us to maintain control over quality while ensuring wide reach. These strengths collectively underpin our overall strategy and competitive advantage in the market. Let's take a moment to consider some of the key risks we face in this industry. First, gold price volatility is a significant factor because fluctuations in gold prices can directly impact our margins. When prices swing unpredictably, it makes financial planning more challenging. Next, we should be aware of our high working capital intensity, which means a large amount of our capital is tied up in day-to-day operations, potentially affecting liquidity and cash flow management. Another important point is the highly fragmented and competitive market we operate in. This environment requires constant innovation and efficiency to stay ahead. Additionally, there's the client concentration risk. Relying heavily on a few major clients can pose a threat if we lose any of them, so diversification is key. Lastly, we need to keep a close watch on promoter family governance. Strong governance practices are vital to ensure transparency and sustainability in our operations. Overall, understanding and managing these risks is essential to safeguarding our business and supporting our long-term growth. Let's take a closer look at the peer comparison for Shringar IPO. Here, we're comparing it with a few notable players like RBZ Jewelers, Sky Gold, and Utsav CZ Jewels. These companies serve as benchmarks to understand how Shringar stacks up in the current market. When we examine the valuation multiples, you'll notice that the PE ratio for these peers ranges roughly between 24.5 and 26 times. Similarly, their price-to-sales ratios are between 1.05 and 1.11 times. What's interesting is that these companies tend to trade within a similar PE range of 20 to 25 times. This consistency gives us a useful context for evaluating Shringar's valuation. It helps us see whether the IPO is priced competitively compared to its peers. Overall, this peer comparison provides valuable insight into market standards and valuation expectations within this segment. It's an important piece in understanding how Shringar might perform and be valued in the broader jewelry sector. When it comes to our decision framework, I want to highlight a few key considerations. First, if you're comfortable with expecting a 20 to 30% revenue compound annual growth rate and see potential for margin expansion, then this could be a good fit. We're also looking at mid-cap jewelry companies, so if you're comfortable with that segment, it aligns well. Additionally, targeting listing gains suggests we're aiming for investments that could see a significant upward move in their stock price as they get listed or upgrade their listing status. On the flip side, there are some scenarios where it might be better to avoid these investments. If you prefer more defensive plays, meaning companies with stable, predictable cash flows, this might not be the right area. Concerns around governance issues or working capital management are also critical. If those are red flags for you, caution is advised. Lastly, if sector cyclicality makes you uneasy, because jewelry can be quite cyclical depending on economic conditions. That's another reason to consider avoiding these opportunities. Overall, these points help us tailor our approach based on your risk appetite and investment preferences, ensuring we align our strategy with your comfort level and the bigger picture of your portfolio. So, to wrap things up with the bottom line, we see a strong growth story that is supported by a reasonable valuation. The business model has been proven effective, and we're actually seeing profits on the rise, which is always a good sign. When we compare our valuation to peers, it appears fair, with a P/E ratio in the range of 24 to 26 times earnings. This suggests we're not overpaying for growth. Additionally, the way we've allocated assets fits well within a growth risk portfolio, balancing potential upside with manageable risk. However, it's important to note that conservative investors might want to stay cautious, especially given the inherent uncertainties in the market. Overall, this slide emphasizes the compelling growth prospects combined with sensible valuation, making it an attractive option, but always consider your individual risk appetite.